Good evening, folks, and welcome to this inaugural post of this blogging adventure. In this evening, we're going to be talking a little bit about investment risk. As a financial advisor, I've had the opportunity to speak with literally thousands of investors, and often what comes up is folks are looking for the risk-free investment. They say, I don't want to have any risk. And what often we forget is that there's really no such thing as a risk-free investment. There are some things that come close and act as proxy. We'll talk about that in a future post. But what I'd like us to all remember is there are at least 18 risks that our investments could be exposed to. So we'll cover those in some degree of detail here tonight. So first off is inflation risk, which really is two separate risks. The first risk is that the business that we're investing in will be subject to the forces of inflation, impacting the return that we receive. And the second risk would be the real rate of return. In other words, after we receive our dividend or our principal with improvement or gains, that the amount that we've received after we adjust for inflation or the rise of cost of goods and services, that is also a risk. Second would be interest rate risk, which that in and of itself is also two separate risks. Technically, the first one would be price risk. What that means is as interest rates change, the value of your assets could possibly change or will likely change. And the second component of that is reinvestment risk. That principal and interest in the future will be subject to different interest rates at that time, causing some risk there. Third, business risk. This is what they call unsystematic risk, meaning it can be diversified away. So this risk is basically the investment that you're making in the business. The business itself may or may not be a wise investment or well managed, and individual businesses are subject to different forces, causing your investment to be at risk. Fourth would be financial risk. Really what that's talking about is the degree to which the company you're investing in is leveraged or using debt to finance its operations. The more debt or highly leveraged the company or business, the greater the volatility or variability in your returns, causing a higher degree of risk. Fifth would be default risk, similar to financial risk, but default risk is really more applicable to bonds or debt instruments. And what that means is the company's ability to pay its investors as promised. Sixth would be liquidity risk. How quickly can you turn the asset into cash without concession to price? And similar to that is also marketability risk, which some folks use those interchangeably, but there's a technical difference there. Marketability risk really refers to your ability to get fair market value for the asset. Moving on to political risk, number 8. Political risk entails many things, but basically political instability, trade disagreements, wars, upheaval, things of that nature could put your investment at risk. Always has. Also along with that, risk number 9, sovereign risk. Really what that is a country's ability to, or willingness I should say, to pay investors as promised. So similar to default risk, but with countries we call it sovereign risk. And moving on to risk number 10, exchange rate risk. If you have any investments across borders, the different currency exchange rates, the fluctuations there could put your investment at risk. Tax risk, number 11, the ever-changing landscape of the tax situation here and abroad will always pose a risk to our investments and impact our investment making decisions today. 12, investment manager risk really has to do with managed money. So we're talking mutual funds or some sort of managed account where the fund manager or the manager of the monies, money manager I guess you could call it, adds an element of risk there as well. 13, often overlooked would be additional commitment risk. Are there going to be future investments required of this investment? And how could that impact your risk today? In 14, I added this one as kind of a side note, but physical risk, if you're holding on to physical securities, the stock certificates, cash on hand, physical gold, those will have physical risks if they're damaged, destroyed, lost, what have you. That adds another element of risk. So our discussion here really revolves around risk, and the purpose here is twofold. Number one, to clarify the understanding that there's really no such thing as a risk-free investment. There's always some degree of risk. It's a matter of what kind of risk. And number two, knowing what those risks are and managing those risks as wisely as possible. So an action item for you would be to take a look at your various holdings and accounts and investments and analyze where your different holdings may be subject to these various risks, and going forward, make sure that you're managing those investments wisely according to these risks. Thank you, and look forward to future blog posts where we will discuss other financial topics, and most notably related to this topic, we'll talk about how to measure risk. Thanks so much.